I had to make this video, or I felt I had to make this video because I'm getting colleagues and clients that are sending me videos that I feel you need to really address and understand the truth about what's going on with gold. Hi, my name is Drew Urosek with The Complete Investor. I know I've got this YouTube page up, and I don't have any problem with this guy, Tom, but this is a perfect example of what I'm talking about and why I'm making this video. Gold just had its worst week in 43 years. Not entirely inaccurate, but definitely misleading, and I'll go over that in a second. There's a lot of misinformation out there and a lot of shock that people are playing on, and at the end of the day, I like to talk about real stuff that's truthful and realistic, if you will. Let me give you an example. Before I get into the exact reasons of what's really going on with gold, and I've made some videos about this, but I want to address kind of like the shock factor and the amount of misinformation, really disinformation. What do I mean by disinformation? Meaning it's not untrue entirely, but it's presented in a way to manipulate you as an investor, okay? Perfect example is someone saying 43-year worst gold pullback in 43 years. That's not accurate. That's like you in your neighborhood saying you've got a house that sold for 100 grand because the person was in foreclosure. It was, in the worst shape ever, and needed a gut rehab to bring it back to market value. But because someone sold that house for 100 grand, that the average house price in your neighborhood is now 100 grand, and it's the worst pullback in values in your neighborhood's history. It's just not accurate, right? But let me give you a little background on me. Drew Urosek, The Complete Investor. You can see me on thecompleteinvestor.net. We specialize in helping people protect their retirement accounts with physical, real gold, real silver. We feel we do it better than anybody else because, number one, we don't push anyone to anything they don't want to do. We educate first. Number two is we're a full service dealer, so not only are we with you on the front end, we're with you on the back end. Also, if you decide to take delivery, right, you don't want to buy gold inside your IRA, you want to have it in your hands. Hey, nobody delivers gold faster, safer, more effectively than us. Gold in your hands in 1 to 2 days. I had people, just got off the phone with them. They've been getting quotes from their dealers saying, 4, 6, 8 weeks, depending on the metals they want. Nope, in your hands, 1, 2 days. That being said, you can check me out online. I have client reviews on my site. These are obviously reviews I put on there, but I encourage you, check me out, Drew Urosek Gold. I only have 5-star reviews for my clients because, again, I educate first. I don't push anyone into anything they don't want to do. Number two is I support you, okay, whatever decision you make. And then 3, I give you access to me. All my clients have my cell phone number. You can call me day or night, okay? But let's talk about what you're hearing online and why you need to be aware of what really happened with the biggest pullback since 2011 is, in my opinion, more accurate, and I would say the most qualified people in the market. Real traders, real investors would say biggest pullback since 2011. Still significant. Don't get me wrong, still significant. But what really happened? Why? We're in a war. Why shouldn't gold go up during uncertain times? Yes, normally, and I believe, and you're already seeing it kind of settle in and pull back here to normal levels, but people can still make money on shock and awe, okay, what's going on in the marketplace. And I'll show you exactly what happened and why it happened. No, it's not the euro dollar credit markets. I love that one. I hear people saying the euro dollar credit markets, people don't have money. First and foremost, I hear this too. Gold investors sold their gold. They had to because they needed cash. No, not one of my customers, and I've been doing this since 2010, myself personally in gold, helping people with their retirement accounts since 2016. Helped literally thousands of people across the country. Not one person called me up and said, I got to get out. Let me sell you my gold. As a matter of fact, I talked to 100 to 150 prospective clients every single month through my marketing efforts. And usually about 20 to 30 a month already have gold. Not one of those people. I buy gold. I pay fair market value. I cash you out same day. Nobody, in my opinion, pays more for gold and cashes you out faster than us. I'll even fly out to you and cash you out if you have a big amount. Nobody does that. I can liquidate you at the comfort of your home. Okay? Not one person wants to sell their gold. I just got off the phone with a guy today. 600 grand. He just lost 10% in a couple days last week on his gold's value. I said, you want to sell? You've owned it for 20 years. You've already made a ton of money. You want to cash out? Nope. He wants to buy more. And as a matter of fact, most real physical gold owners want to buy more when we have the first big pullback in, since 2011, right? More accurately stated. So what really happened? So tell me, Drew, what happened? It wasn't the euro dollar credit market. It wasn't the worst, 43 years. It was still big. And what exactly happened? Well, just follow the money. Just follow the money. Real gold didn't sell. Real gold didn't sell. Gold futures sold. And again, if you remember my statement, that's actually where I got my start. Buying and selling gold contracts when I worked out of the Chicago Board of Trade building, the number one commodities and futures exchange in the world. I used to work for one of the top futures traders, top S&P futures traders when I was working out of the Chicago Board of Trade. I also worked for one of the top options traders, actually famous for taking Amazon.com public as the market maker. So I used to work for the best of the best, okay? And specifically, I traded gold contracts myself personally. So I know this market. Gold futures sold off. Not real gold, the speculation on gold futures. Now just imagine you're a big fund manager, you play in the futures markets, and you know that 20% of the oil production is going to be cut off, along with natural gas, along with farming chemicals. If you knew that 20% of all oil production is going to be cut off, and the majority of oil production for the Far East, right, the Asian markets, where would you put your money? Oil and oil companies. Let me show you. So I'm going to just pull over a chart here on gold futures. And this is what everyone wants to shock you with, right? They want to take the highest gold ever got, the lowest gold ever got, not closings, just within the market, and say that's the worst pullback in 43 years. Not really accurate, right? Or at least misleading. The big sell-off everyone wants to talk about happened here. This is one day, and then that continued sell-off. Okay, so remember this time frame. Okay, and then this is the final before it bounced. So about 3 days, serious pullbacks. Well, first thing you have to understand about futures, it's a leveraged market. Each contract controls 100 ounces worth at the beginning of this sell-off, $500,000 per contract. Guess how much money you need to control one contract as a futures trader? Usually about $7,500, $7,500 to control 500 grand in gold futures. Well, if all of a sudden the market starts selling off, right? And I heard someone say, you can tell that gold's over because it was selling off during the war and it accelerated into the sell-off. No, people don't realize you have to have margin call, right? If I'm leveraging you, I'm giving you credit to control a contract worth way more value than you're actually putting money in, and the price comes down significantly, you're not only going to have what's called a margin call, you're going to have increased margin. I have a futures contract account right now, and I get emails from them all the time when this happens. If there's volatility, right, where the market price swings a lot, they'll increase margin. So not only do they require you to have more money in your account to cover what you're controlling in the asset, the underlying asset, you also are required to have more money to keep on trading. So if it costs me more money to trade this contract, I'm just going to take my money out. I'm going to trade something else, right? If it costs me more money to trade gold, why not trade something else I know is going to make more money? Oil. So I'm just going to grab one company. And I know this company, it's near and dear to my heart. It's a pretty funny story. I own this company, EOG. I have the stock and I play options on it all the time. And why I'm laughing is because EOG is the former Enron. Not for the faint of heart. I'm not telling you to buy this stock. I've owned it for a long time now since it came back out. And I do a lot of options trading on this. Okay, so I've owned it for a while. And I've been taking advantage of this move up since I own it. Okay. Wait a minute. Isn't this the same time frame? It accelerates. Remember how gold accelerated down? Accelerates up. Accelerates up in the exact time frame. The exact momentum up in the inverse of gold futures, right? If you know the oil companies are going to increase in value, because especially the U.S.-based oil companies, right? Because if the world can't get the oil from the Middle East, where else are they going to get the oil? From American oil companies, right? So a lot of money went into American oil companies, okay? This one's EOG, formerly Enron, okay? And you can look up all the oil companies. They all went up. They all went up. And here's oil futures. Here's oil futures during that same time frame. Now, this had been going up. Oil futures moved faster. Money moved faster into oil futures during the Gulf as soon as we started going into Iran. So you can see the spikes already happening. But here's the specific spikes that happened when gold was dropping and that acceleration of gold dropping. And this specific acceleration probably happened when margin calls started happening, because you had the first sell-off in gold. You probably had margin calls of certain values. You had margin increases to control the contracts. You can't just do $7,500 a contract anymore. Maybe your brokerage went up to $15,000. Maybe even went to $25,000 to control one contract, right? Boom, exact time. Oil spikes. If it doesn't cost more money to get oil contracts, and you know oil is going up because of the limitation of fuel going around the world now, right? 20%'s gone. Why not move my futures money from gold to futures money in oil, right? From gold to oil. Now, there's a little known phenomenon too. Where else did money go? Treasuries. If you're a fund manager and you know the companies that you invest in Asia are going to start losing money or not be as profitable, and you've got to make up a percentage of return on the money that you're going to be losing in Asian investments, why not get a short-term return that is basically guaranteed? U.S. Treasuries. Now, U.S. Treasuries are a little harder to see the volume increase because they're held in auctions. And we have more debt than anybody can buy. That's why our government has to buy some of our debt. So it's a little misleading if you go to the Congressional Budget Office and look at the Treasury auctions and say, was there an increase? Because you're not going to see the true number. But a little known phenomenon happens when Treasury volume increases, meaning companies start flurrying and investors start flurrying to buy Treasuries. A little thing happens in bond futures. Let me show you. When you have a huge spike in bond futures, because 4.5% return is great, you see a decrease, initial decrease in bond futures. Why? That doesn't make sense, right? If more people are buying bonds. Because futures expire. So if I know there's an increase in bond futures, right, or bond values, actual real bond purchases, I have to extend out and move my contracts. So I have to sell the current contract and buy future contracts that are going to expire later. So there's an initial fall in values in bonds futures. And this is a 2-year note, and you can see it also in the 10-year note. So this is a little known phenomenon that futures traders would know that the average person wouldn't know, right? Because if there's an increased purchase of real bonds, right, 2 years, 10-year treasuries, right, you think futures would go up. Well, again, when there's that much value increasing in bond purchases, treasury purchases, me as a futures trader, I got to go, oh crap, I got to move out my contract. So you sell the current contract and buy the longer term contract. So this is where the money went. Nobody was losing money because, especially in Asia, the euro dollar credit market in Asia, they don't rely on the euro dollar credit market. They are their own market, right? The euro dollar credit market for Europe, right? And American transactions, or at least majority, I should say. So not that the euro dollar market's not a mess, right? But that's not how companies work. That's not how countries work. If a country wants to increase the money that they have to issue treasuries, and they have to get someone to buy those treasuries, right? That increases their money supply, right? Which is basically indefinite as long as the country is willing to buy its own treasuries, which everybody does, and we are the masters of it. So at the end of the day, what really happened? Well, gold really went down. Right? It really did have that pullback that everyone knows happened. Let me go to gold here. Gold really did pull back, right? It was a bad one. Worst or biggest since 2011 is more realistic, or at least in my opinion, and the opinion of real traders, real investors, which is really a buying opportunity, right? Because the long-term prognosis is we're increasing our debt, and we're being farther and farther removed from the real value of money, okay? Because fiat currencies are based on credit, not assets, right? And we can only borrow so much money. We no longer have enough money to pay our bills. And we're increasing our debt so much that just the interest alone is more than our entire military budget every year now. And it's only going to get worse. There is speculation that we will be near or at $100 trillion in debt by 2030. That's insane. The chances of us defaulting on our debt goes up, not down when we keep on borrowing money. Gold, and you can look at the history of gold, as we increase our debt as a country and other countries increase their debt, gold goes up. It is globally recognized, it has its own sovereign value, and it's not tied to anybody's debt. So if our debt more than doubles in the next 4 years and gold goes up with our debt, doesn't it make sense that gold should double? And you can look at top analysts from JP Morgan Chase, even the CEO, right? Jamie Dimon is calling for $10,000 an ounce gold. Ed Yardeni, $10,000 an ounce gold from Yardeni Research, right? And you can look at other analysts out there and you can do your own research, but there's a lot of people speculating gold just based on debt should be at about $10,000 an ounce by 2030, right? And that makes sense. These pullbacks are the futures markets. These are highly manipulated, quick money moves by the biggest money managers in the world, moving so fast that the average person obviously is going to be shocked and worried. But at the end of the day, this is my personal opinion and why I own gold in my IRA. My wife has it in her IRA. We have gold in our safe at home. Heck, we got gold in our parents' safe at their house. This is why I own gold, because I know this debt is out of control. This is usdebtclock.org. They get their data from the Congressional Budget Office, okay? It's $39 trillion. By the way, that's the treasuries that we issued. Our total debt as a country is over $100 trillion. This is just the amount that we plan on paying back. Plan on. And again, If we know that we're going to be going to $100 trillion in debt by 2030, gold goes up with our debt, has since we started this fiat currency called the US dollar, right? Not tied to any physical asset. That's why a lot of people say, hey, gold could easily be $10,000 an ounce by 2030. Yes, we're going to have these little head fakes and money manipulations that happen over time, but at the end of the day, you can follow the money. We knew that the oil production was going to be cut off, or at least the big money players knew that was going to happen. Well, if 20% of the oil production is going to be cut off, let me move it into oil and oil companies. And you saw that massive move, right? And hey, I know I'm going to be taking losses in my Asian, corporate exposure, right? Investments in Asian companies, right? I know I'm going to take a loss. Where can I get a return on my money that I know will be there? Let's buy treasuries. Let's buy treasuries. They're paying 4.5%, right? If I just do it for, a year or two, I can put it back into gold later, right? That's the thought process. So don't get, sucked in by the shock jockeys, right? People that try to use terms that you don't understand and headlines that seem, just shocking, right? 43 years. Oh my God, what did I get into gold for? Listen, it is scary. Very scary times, right? But in my opinion, that's why you want to be in gold, right? Why you want to be in physical precious metals. I hope that helped at least enlighten you on what's really going on with no hype, real money moves. You can see where it went. There was no, funds were cut off, so gold investors sold their gold. Nothing could be further from the truth. Shocking, yes. Scary, maybe, right? But that's the real, information that I wanted to share to calm everybody down and really understand what's going on. Thank you so much.